Hello, everyone, and welcome back to another episode of Tax Thursday, brought to you by Smart Counsel. I am your host, DDQ, here with Smart Counsel's tax resident attorney, Dionne Kellier. Dionne, how are you? Well, happy Tax Thursday.
I am well. How are you? Happy Tax Thursday.
I'm doing well. I'm glad to be back. We have taken a little leave of absence just because life, happens. So thank you all for hanging in there with us and sticking with us through these changes. But yeah, for today, we are going over a new topic, and that topic is what is considered non-taxable income, which is a very common question. I figured after doing some research. So I guess my first question is: are there different types of income?
There are. The IRS categorizes it into taxable income, which is mostly anything, and non-taxable income, which these are enumerated things. So let's first start with what is considered gross income, right? Because gross income is different than taxable income. You start at gross income to then get to the calculation of what is taxable income. So IRS Code 61 defines income, and so what defines gross income. So what is gross income? Compensation for services, including fees, commissions, fringe benefits, and similar items. Gross income derived from businesses, so if you're self-employed. Gains derived from dealings of property, so if you flip properties. Interest, rents, royalties, dividends, annuities, income from life insurance and endowment contracts, pensions, income from discharge of indebtedness, distributive share of partnership gross income, income in respect of a decedent, and income from an interest in an estate. So non-taxable and taxable income are included in these things that I said was gross income, right? But when you start to work down the numbers, you'll see what's taxable and what's not taxable, right? So the IRS's definition of non-taxable wages and other exempt income is a fairly narrow window. So generally, any amount included in your income is taxable unless it is specifically exempted by law. So income that is taxable must be reported on your tax return and is subject to tax. Income that is not taxable may be shown on your tax return, but is not taxable. So in the law, shall means you must, and may means that you can. Right?
So it's not like a mandatory thing,
exactly.
Like shall.
So shall means yes, you have to do it no matter what. May, maybe it depends on this, it depends on that. So that's the distinction.
Okay.
So there are 3 types of income that the IRS says exist: constructively received income, assignment of income, and prepaid income. So constructively received income is generally your tax on income that is available to you regardless of it's in your possession or not. So say that you work somewhere and the pay schedule was like every 2 weeks, right? And so like you're at December 31st and you're going to get a check on January 4th that covers the 2 weeks prior. That means that in your prior year, you're going to include that check that you get on January 4th. Because even though you receive it in the following year, it is it's wages constructively received income from the previous tax year. So that's one thing. Or if you have a check that you're supposed to get, like even if you're trying to avoid it, if these wages are to be paid to you, or this income is to be paid to you, it is considered your taxable income. There's 2 types of taxpayers: cash and accrual. Accrual means that the rule that I just said doesn't necessarily apply to you, and that's typically in businesses. Individuals are cash basis, but like businesses could either be a cash or accrual basis. So accrual means like, yes, I earned the money here, but I received it then that means that I can include it in either or tax year. Typically you include it when you receive it. Whereas a cash basis taxpayer, they include the income as soon as they earn it, they receive it. Even if they don't get it till 2 weeks later, but the fact that I made $500 on this job, that means that $500 needs to be included. I don't have to get the check yet for the IRS to say that that's my obligation.
Oh, okay.
Right? So
Interesting.
there's another
Mm-hmm.
assignment of income. So income received by an agent for you is income you constructively received in the year the agent received it. If you agree by a contract that a third party is to receive income for you, you must include that amount of your income. Sounds a little bit difficult, but the example is that you and your employer agreed that part of your salary is to be paid directly to your former spouse in terms of like alimony. So you have to include that
Mm-hmm.
amount in your income, even though your spouse receives it. So if I'm getting $100, but $50, if I'm supposed to get paid $100, but I tell my boss, listen, don't give me the $100, pay me 50 and then pay the other 50 to my former spouse, I am going to be taxed on $100, not $50 that
Right.
I actually receive.
What about the spouse? Would they tax that,
Well,
or is it already handled by the initial?
alimony payments are not taxable. Alimony that has been determined after
Oh,
2018 are not taxable to the recipient.
interesting.
Very
Okay.
interesting. So that at the end of like that's why like at December, it was December whatever, December of 2018, people were going crazy. Actually November. It was actually this, so the cutoff was December 31st. So people were going crazy to either amend previous alimony agreements or get their alimony agreement in so that at that time the income would have to be included in the recipient's in the recipient's gross income calculation. But after that, I'm not gonna say it's free money because don't worry, the IRS swings around in another direction and accounts for that.
Yeah.
So, uh,
Interesting.
and
Okay.
then the final type of income is prepaid income. So, such as compensation for future services, in general, is generally included in your income in the year you receive it. But if you use the accrual method of accounting, as I said, you could defer the prepaid services until you actually receive the income. And so you might also be required to file for other reasons, but there are income thresholds for who has to file a tax return at what number. I'll explain a little more. If you're self-employed or paid on a 1099 miscellaneous form, or you bought health insurance from a state or marketplace, you're going to have to file a tax return regardless, just to show the amount of income, even though you may not have to pay taxes. And in most cases, if you only receive Social Security benefits, you will not have any taxable income and would not need to file a tax return. So this is for our 65 and older people, right?
Uh-huh.
But one catch with the Social Security benefits is that if you are married but you file a married but separate tax return from your spouse who you live with during the year, then you have to include at least some of your Social Security benefits in your taxable income. And there is a formula that you do, but basically, if the amount that you receive is going to be higher than your standard deduction, then you're probably going to have to include half of it in your income. That's just like the simple line from it.
Okay. Kind of easy way to put it.
Exactly. So for the 2021 tax year, if you make more than $12,550 or $14,250 and you're filing single, you have to file taxes. So you can make up to $12,000 or $14,000 and be, so $12,000 if you're under 65 or $14,000 if you're over 65, and you don't have to file taxes. If you're married filing jointly, if both of you are over the under the age of 65, you don't have to file taxes until you make in excess of 25,101, because at 25,100 and under, you don't have to pay taxes. And if one spouse is under 65 and one spouse is above 65, then you can make $26,450 before you have to file taxes. And if both spouses are over the age of 65, you have to make $27,800 before you have to file taxes. If you're married filing separately, do you know how much you have to make to file taxes?
No.
$5.
What? Really?
Yes, there's a penalty for married filing separately, and that's the penalty.
Yeah.
Basically, you're gonna have to account for it. And there are reasons why you would. I feel like if you're married, filing jointly is the benefit. So why you would file separately, I'm sure that there are reasons for it. But I guess that's something you have to discuss. But you have a $5 threshold, so I don't see how it's beneficial to you.
I mean, I feel like throughout all of our tax Thursdays, filing married but like jointly or like separately just doesn't really have the benefits. I just wonder what would those reasons be for couples to do that.
So I think one of the reasons are if one of the spouses come into the relationship with a tax obligation already happening, right? Then you don't want your refund or whatever to be affected by whatever the other person's already standing tax issues are, right? That's what I really think is the big thing, because I think it's more beneficial. You can't even make the same amount of money as a single person and get the benefits of a single person. You literally get no benefits if you file separately. But I know that there are reasons, and I know that there are people I'll be like, no, you need to file separately, because even you trying to split the income to not get like the net income benefit or have to have the AMT, the alternative minimum tax, that doesn't work if you file separately. You get no benefits basically, and you can't file for any of the subsidies either, and you can't file for the tax credit either, the child tax credit.
Yeah.
So
Right. I do remember that. Interesting.
So I don't see why, but that.
There's reason for everything.
Exactly. All right. So if you're head of household, if you are under the age of 65, you can make $18,800, and if you're over the age of 65, $20,500 before you have to file taxes. And if you are a widower with a dependent child, you can make $25,100 if you're under the age of 65, or $26,450 if you are over the age of 65. So, non-taxable income won't be taxed whether or not you enter it on your tax return. What items are deemed non-taxable by the IRS? Inheritance, gifts, and bequests. Cash rebates on items you purchase from a retailer, manufacturer, or dealer. Alimony payments for divorce decrees finalized after 2018, so the recipient is not taxed on alimony payments. Child support payments are not taxable. Most healthcare benefits, money that's reimbursed from qualifying adoptions, and welfare payments. Under certain circumstances, the following items may be non-taxable. So money you receive from a life insurance policy when someone dies is not taxable. However, if there's cash in a life insurance policy, then a portion of it, if not all of it, is likely taxable. So the death benefit is not taxable, but anything above the death benefit is taxable. And money from qualified scholarships is not taxable. However, if you use the money for room and board or use it to pay other personal expenses, that amount is taxable. And I learned that when I was working with TurboTax, because like people are doing their taxes, and I'm like, why are you being taxed on scholarship money? But if you can only use the scholarship money for like these enumerated things, and if you don't use it for that, it's taxable.
Wow. Does that differ through like where you're going, like through universities, or is that just kind of like an overall?
It's an overall thing that nobody talks about. The American Opportunity Credit, and then there's another one. There's another credit that you get. That all of these things, if you use that money for anything other than your tuition and your not even your room and board, it's your tuition. Yeah, and your room and it's your tuition, right? If you use it for anything other than your tuition, then it's taxable, because your room and board will make it taxable, and if you buy your books, it is taxable. Right. So like even if you get a full ride somewhere, guess what happens? Those kids are being taxed whatever was spent on books, so they end up getting a 1099 at the end of the year. Yeah, so it's an interesting thing. So okay,
that is.
So we'll get into like each thing. So gifts. Taxes on gifts are usually paid. I got hair in my eye. Sorry. It's like it's folded up. Okay, perfect. It's folded up in my glasses. I'm like, oh my god. Okay. So taxes on any gift are usually paid by the giver, not the receiver. And any gift an employer gives out, therefore, is only taxable for the employer. Individuals can gift themselves with up to whatever the gift tax is. It's like it's like $15,000 per year. An individual can gift $15,000 to as many people as they want in a year. A married couple, $30,000 to as many people as they want in a year, and it's not taxable. It's not going to be included in their gross income. But if you are an employer, you can only give non-taxable gifts up to $25. Any higher gift than that must be claimed by the recipient. And company bonuses and profit sharing plans are not considered gifts. So you're going to get taxed on it as the recipient regardless.
Right. And is that after a certain amount?
No.
Aren't like gifts taxed after like a certain amount?
So for employers after $25, but on the individual gifting, if you don't even do that calculation. So say that you as an individual give somebody $30,000 in this year. That's double what you're allowed to give them. You can file something that says in this year, I gave an additional $15,000, but it kind of all works out because it's really going to be at your end of life taxable estate consideration. How much money did you give away, and was that above the threshold that you could give away? If all of the numbers work out, then you're not going to pay taxes on it, even if in 1 year you overgave.
Right. And would gifts kind of fall under the same category as a donation then? Like if you're donating to certain charities or.
That isn't another section, because that is
Okay.
itemized. It's an itemized deduction, and it's a charitable itemized. So when you're doing a charitable contribution, you do an itemized deduction, not a standard deduction, right? Because you want to itemize how much you gave. Before tax reform, there was a threshold that you had to meet. I can't remember it off the top of my head, but I know, like, in order to deduct medical expenses, this is still the same. It has to be above 7.5% of your adjusted gross income. So whatever it is above 7.5%, you're able to deduct. So, like, say for instance, you made $100,000 in a year. After your medical bills exceed $7,500, you're allowed to deduct anything above that. But anything below that, you're not allowed to deduct.
Right.
Let's see, disability wages. So this, to me, this is such an interesting, I always found it interesting in law school as well. So any employee who has been declared temporarily or permanently disabled may be eligible for disability pay, and disability wages fall under non-taxable income. However, if these disability payments come from an insurance policy where the premiums were paid by the employer, then the money will be taxed. There are many disability payments that are not taxable, and these include any payments from supplemental disability insurance paid for with after-tax money, private disability insurance, and workers' compensation, and also any damages awarded that were compensatory, not punitive, due to injury, sickness, or loss of function are not taxable. The part that I found interesting in law school, if you receive a damage award that is punitive, so basically punishment to the person that caused it, right? So think of a situation like when Johnson & Johnson had the talc baby powder situation, right, that caused cancer. So when the person that filed the suit, when they got the award, there's a science to how much of this award is for compensatory damages, meaning to compensate you for the damages that you actually had, and then how much of it is to punish Johnson & Johnson because they knew that the talc caused cancer. Everything that's on this side, any amount that's on this side is taxable.
Would that be to Johnson & Johnson?
No, taxable to the recipient. Where anything that's compensatory is not taxable. So it's as if you got $0 on this side because you're not paying any tax on it. But say that, like, I think the award was like $33 million, and $3 million of it was compensatory, and then the $30 million will be taxable at whatever their rate is. And another thing with these kind of damages, only physical disabilities are non-taxable. Like if you get an award for a physical disability, but say that you had emotional distress caused by whatever happened and you get awarded for that money is taxable. But say that your emotional distress caused you to be crippled in fear and like you can't move anymore. I don't know, like something that then happened to you, that part is not taxable, the physical part. So if they now award you, let's use the $30 million example, $15 million for the emotional distress and $15 million for the physical whatever that came from the emotional distress, this $15 million is not taxable, this $15 million is. The emotional distress, they don't care. They're like, oh well.
Yeah, figure it out. Yep. And that's the IRS that determines all of that.
Well,
right?
That's the IRS. So it's the IRS and the law, right? Because a lot of people, it's the IRS's rule. A lot of people try to fight against it, and the IRS is like, no.
Yeah, for sure.
So
IRS, you gotta love them.
All right. So what else? States without income tax. So any wage earned in one of the states that do not have state income tax is considered a non-taxable wage as far as state taxes are concerned, but it's still taxed by the federal government. And then there are the states that don't have income tax: Alaska, Nevada, Florida, Texas, Tennessee, South Dakota, New Hampshire, Wyoming, and Washington. And if you have a business that's incorporated, Nevada, South Dakota, Texas, Washington, and Wyoming offer corporations a break by not taxing corporate income. And but the state doesn't tax it. Federally, you're going to get taxed. There's no way around that.
Right.
Insurance
Right.
provided by the employer. Any payments an employer makes towards an employee's insurance of any type are not taxed because they're actually considered part of the employee's income. And the same is true of any payment that the employee makes towards their own health savings account. And it doesn't matter if the insurance is provided by a third party or through a health reimbursement arrangement. It's not taxable. Life insurance payouts. Most life insurance payouts that are paid out to an individual due to someone's death may not be taxed. However, it's not true if the policy is cashed in or if there's a cash value above the death benefit. Let's see. Scholarships and financial aid as an employer. If you provide educational assistance to an employee, the IRS says that 5250 a year are not taxable and does not need to be included in the employee's in their income. But luckily, if you're the employer, it's a deductible expense to you. So I mean, it's never bad.
Yeah.
As a student that receives scholarships, it's not taxable if you use it to pay your tuition, your fees, your course materials, or your textbooks. But if you use it for anything else, it's taxable. Welfare benefits are not taxed income, so food stamps and other assistance. Let's see. The American Rescue Plan Act of 2021 increased the maximum amount that can be excluded from the employer's income through a dependent care assistance program. So for 2021, the amount increased to $10,500 from $5,000. I think we talked about that on our last show, actually. There's a temporary allowance of 100% business meal deduction. So Section 210 of the Taxpayer Certainty and Disaster Relief Tax Act provides that a temporary allowance of 100% business meal deduction for food or beverages provided by a restaurant. So like if you have a luncheon at your office and then you get food from a restaurant, that's 100% deductible from December 31st, 2020 through January 1st, 2023. Deferred compensation contribution limit was increased. So if you participate in a 401k, a 403b, or a government thrift saving plan, you can contribute up to $19,500. So that is income that is not going to be taxed, right? Because it's pre-tax income. Health FSAs under cafeteria plans, $2,750. So if you take $2,750 and you contributed that to the health FSA, then that income is not taxable for the taxpayer. So it's as if you never received it.
Right.
A gross income does not include any amount arising from the forgiveness of a PPP loan, and it's effective for tax years ending after 3/27/2020. But it does not. And it also is for the first, the second, whatever. If you got a PPP loan and you did everything that you needed to do, it is not included in your gross income, even if they forgave it. But it, like other things, typically how the world works, if you forgive a debt, it is considered income to the person that didn't pay back whatever debt it was.
Oh.
Yeah, so that's typically how that works. So like when people were going through foreclosures, a lot of foreclosures, then like at the end of the year or the beginning of the next year, they'd be surprised because they get a 1099 that is saying that, they got income. Well, so if they did a forbearance plan, or if the IRS or if the mortgage company accepted less, they did a short sale, the amount that you were forgiven would be considered income to you, and it'd be taxable to you.
Wow.
Yeah,
that's a fun surprise.
That came as a surprise to a lot of people, and there's nothing you can really do about it. And sometimes the mortgage company determine what kind of 1099 they gave you, and like sometimes they can give you a 1099 that would not be considered taxable income, but for the most part, it's considered taxable income. The Families First Coronavirus Response Act, it provides that tax credits for self-employed individuals carrying on any trade or business, and it's basically if they had to take a leave. So if you're self-employed and you had to leave your job because of Corona and you got certain payments, you don't have to include that in it because you were affected personally by the virus. You don't have to include that in gross income. If you got an emergency financial aid grant under the CARES Act, that's excluded from income. Any economic impact payments are excluded from taxable income. Any other loan forgiveness under the CARES Act is excluded from taxable income. If you are a volunteer firefighter or emergency medical responder, You may be able to exclude from gross income certain rebates or reductions of state or local property or income taxes, and up to $50 a month per month provided by a state or local government, which I think is like so ridiculous, because like you are a volunteer firefighter and medical person, and you're getting a $50 a month.
Yeah, no, definitely. That doesn't really make sense.
Like, yes, you can make, so like I don't even I feel like nurses, I feel like first responders, nurses, doctors, firefighters, the ambulance, anybody in that first responder position that is being exposed, especially during, not even just during the corona times, but just in general, like $50, right? Just like teachers, like what is $50 gonna do? Like, and where you would give somebody else that has more money and more resources will have the ability to deduct more. That's the catch-22 of having this information, right? I have the information, I know how to use it, I know how to use it to my advantage, but even if I use it to your advantage, it's not advantageous. So okay, yes, right. You could deduct the $50 a month.
Yeah, it's not gonna do anything. It's like not even gas.
Right, exactly. So that, like when you start to see things like that, it gets a little frustrating, but I mean, like, I know, Rome wasn't built in a day, so maybe one of these days these things will change. We'll see.
Right.
So let's see. The alimony received will no longer be included in your income if you entered into a divorce or separation agreement after December 31st, 2018, or if you entered in one before then, you changed it to reflect the new law. Let's see. For tax years beginning after 2017, certain qualified employees can make a new election to defer income taxation for up to 4 to 5 years for qualified stocks received. That's an employee compensation situation. For tax years beginning after 2017, reimbursement you receive from your employers for the purchase, repair, or storage of a bicycle you regularly use for travel between your residence and place of employment now has to be included in your gross income. Before it was a deductible expense.
Really?
If you received unemployment compensation, but you did not receive a 1099-G, you're going to probably need to ask for it. Even though unemployment compensation there is a threshold, and especially in 2020, there was a threshold that couldn't be taxed. I want to say it was $10,000 that you could receive, but now if you received unemployment compensation, you're going to get a 1099-G. It's going to come from the state, and you have to include that in your taxable income. Let's see. If you were wrongfully incarcerated and you receive remuneration or payment from the state for their wrongful incarceration, typically that amount is not included in your taxable income.
It's not
right. So that's good.
That is good.
That's good, right? But I mean, yeah, you lost 20 years of your life. You might have got $1 million, but you lost 20 years, right? So I don't know.
I know.
I'd rather my 20
I mean,
years.
It's better than like them taxing it.
That's true,
like,
right? Yeah, you're right.
The bright you're like getting taxed for that.
The bright side, you're right. Olympic and Paralympic medals and United States Olympic Committee prize money is not included in taxable income. Public safety officers. A spouse, former spouse, and child of a public safety officer killed in the line of duty can exclude from gross income survivor benefits received from the governmental Section 401A plan, and is that was attributable to the officer's service. A public safety officer that's permanently and totally disabled or killed in the line of duty, and a surviving spouse or child can exclude from income death or disability benefits received from the Federal Bureau of Justice Assistance or death benefits paid by the state program. Certain payments you receive for providing care to an eligible individual under a state's Medicaid waiver program may be excluded from gross income. And qualified settlement income. If you are a qualified taxpayer, you can contribute all or part of your qualified settlement income up to $100,000 to an eligible retirement plan, including an IRA. Contributions to retirement plans other than Roth or a designated Roth contribution reduce the qualified settlement income that you must include in income. So basically, if you get like a big settlement and you become a qualified person, and I think it depends on the different circumstances, whatever amount you contribute to your IRA is not going to be included in your taxable income, but you are also subject to certain limits, but then there's certain catch-ups. So you'll be taxed. You may be taxed. That's a may, right? You may be taxed, and you may not. We'll see how we work the numbers out. And that
Okay.
is non-taxable income.
That is a lot of information, but it's very useful, like you said.
Yeah,
And with all of that non-taxable, that you have the option, you may include it on your tax return, correct?
right. You may include
Okay.
it, but my rule of thumb is going to say to include it. And then
Yeah.
adjust, right? Because that's how you do. You have your gross income, and then you have your adjustments to gross income, which you can explain. I received this, that, and this, but this is why. So then you're gonna. So you make 100,000, but then there's an adjustment of 50,000, and this is why. Section this, section that says adjustment. So now my taxable income will be 50,000 as opposed to 100,000, and you guys can see it. It's all laid out right here. This is why.
Right, right. Yeah, just better to cover your bases, right?
Yeah.
Versus
With the IRS,
getting.
always cover your bases and always like tell the story. Tell the story. Don't let them figure out the story. Everybody can think for themselves, but you want to be like A, B, C, D, E. Don't like have A over here and B over there and C over there. No, no. This is the story. And then so they
Right.
take their information and your information and they put it all together and make sense. Because if you put the IRS in a position where they have to figure it out, they're not going to give you the benefit of the doubt. Not that they're good or bad people or whatever. It's just they have a lot to do. So you figure it out. You do the story to them and you lay it out to them. This is why I didn't claim this income. Because the other side typically is going to send a 1099 or something letting the IRS know that they paid out these amounts. And all relationships are good until they're bad.
Right. No, for sure. It's just that I feel like it's less work for you to do it right off the bat versus, again, this back and forth with the IRS. Like, well, where did this come from? And what is this? Now prove it. And,
Exactly.
you know.
I agree with you wholeheartedly.
So, if we were to file or put anything that's non-taxable on our tax return, is that a whole different form? I know you mentioned the G for
1099-G, that's what you receive from the person.
Well,
You receive that from the government. But like 1099s, they come from the payer. They don't come from you. From you
right.
can just like there'll be a schedule that you can explain. So like if you go to the tax form and it has like adjustments to income, and then there'll be like something that says see schedule A, see schedule whatever. Like the IRS is pretty good about
Right.
making things, even if you use like TurboTax for instance, like they ask you these questions and then at the end they take all the information you gave them and put them in the schedules that you where they need to go. But there's always a place to explain something to the IRS. Always an explanation place. Always. So even if you don't see it, here, then just go down a little further. And even if there's something that you're looking for and you do not see it anywhere, at the end you freestyle.
Yeah, right. Just put it all on there so they know and they have the information.
Right. And actually, I wouldn't even say that. In CPA, man, that's a CPA or TurboTax or what is it, H&R Block, or I find those if you're just doing just standard returns. I don't think any of those like big box people are wrong. I think TurboTax is great, right? If you are just an individual making under a certain amount of money. And even if you make over, up to a certain threshold, right? I think you can do TurboTax if you make probably up to $250.
Okay.
And anything over that, I feel like you should have a tax professional, assist you in that.
Yeah.
And yeah, that's my opinion on that. And if you're a business person, you need to have a CPA. And you need to have a bookkeeper and a CPA. You don't want your CPA to be your bookkeeper because that's an expensive bookkeeper.
Yeah, I know for sure. And so I'm really curious to learn more about like the student loans and the scholarship, taxing on that, especially with talks about it being forgiven completely now in the future. It's been pushed back so much because of COVID, and now it's just in the air that we may not even have to pay that back.
Yeah, no, it's not in the so yeah, it's in the air a little bit, but funny enough, I got my call last week. Hey Dionne, we're gonna start your payments September 1st, okay? I was like, oh, okay, you're good. Your address is still the same. Yeah, great. Thank you. This is gonna be great.
No way.
They sure did. I was like, oh, okay. So, but if you work in public service, that you're gonna be forgiven.
Okay.
Yeah, public service. If
Okay.
you're there for 10 years, then that is almost a guarantee to be forgiven. Anybody
Yeah.
else? So I think so. Next week I was gonna talk about, and I found it today actually, but I'm gonna add it next week. I'm going to talk about what is considered employment income, right? Because fringe benefits, all these different things that you're getting from your employer, like you don't know that it's considered income. And so I'm gonna talk about that, and then I'll get into the scholarships. Like I'll get into that scholarship thing, just kind of break it down a little bit more, because it's something that you need to know, and a lot of people find out when it's too late, when they have to pay the taxes on it.
Yeah.
But
Definitely.
have no fear. Even if you get a tax bill that's $20,000, you can pay. You don't have to pay everything right now. Just don't ignore the IRS. Of course, come and see me. I can work through, certain things for you. But like, you don't, no matter what it is, the only time that the IRS leans and levies you is when you ignore them. Period.
Yeah, for sure. Yeah, definitely.
Yeah.
Awesome. So big takeaway from today's topic would be, what would you say would that be?
Big takeaway is that there are certain types of income that you don't have to, that are not taxable, but you still should include it on your tax return. So if you get an inheritance, a gift, then that's not taxable, but you still should include that amount. The IRS wants to know. The IRS just wants to know what's going on. That's all. If you get a cash rebate on something, so say that you buy something and you get a $50 cash rebate, that's yours, not taxable. If you're alimony, child support, so if you're getting a divorce, I hope you're not, but if you are, for anybody, alimony payments and child support are not taxable to the recipient. So that's unfortunate. And the payor is taxed on that money. So just know that. It's unfortunate. It is what it is. Welfare payments are not taxable. And if you get certain benefits from your job, it's not taxable. And if you're ever in doubt, include it.
Yeah, for sure. Definitely. That's a good, biggest takeaway right there. If you're ever in doubt, just include it, guys.
Exactly.
Awesome. Well, thanks so much again, Dionne. This is a very interesting topic. I think we all learned so much on what is non-taxable, what's taxable, what to include, what not to include. And I think it just opens a lot more questions that we can definitely answer in future Tax Thursday episodes. So thank you again.
Of course.
For that. And thank you everyone for tuning in to another episode of Tax Thursday. You can always contact us on Instagram or via email at attorney@smart-counsel.com. Let us know what you think. Make sure that you like this video, subscribe to our channel, turn on your bell notifications so you don't miss out on a future Tax Thursday, and visit our website at www.smart-counsel.com to learn more about our attorneys and our firm. Until then, we will see you guys next week for another episode.
Thank you so much. Thank you so much, Didi. Happy to be back.
Yes, me too. Thank you.
All right, bye-bye.
Bye.